I wanted to take a look at consumer discretionary spending versus consumer staple spending versus the benchmark investments, the S&P 500, of course, and the 10-year Treasury yield. How do consumer discretionary spending ETFs, specifically XLY stock, versus consumer staples, XLP stock, the ETF for consumer staple, that little subcategory there, how do they match up? Comparing these two stocks, XLP stock versus XLY stock, the ETFs, versus, say, SPY stock, the ETF versus the S&P 500. I'm looking back over 20 years, putting everything together so that you can get a good idea as to what these ETFs do, each subcategory, consumer staples and consumer discretionary, then comparing them to the S&P 500, the benchmark investment for stocks, and the 10-year Treasury, the benchmark period. Which one's better? Let's jump in. I'll break some things down for you, show you what you should be looking for with an investment in either XLP stock or XLY stock, and what could possibly happen with the economy moving forward. This is the big question mark that we have because of potential of higher or lower interest rates, which would affect everything. Let's jump in. First and foremost, if you're just finding my channel here, thanks so much. Make sure to hit the like and follow button. I'm D.H. Taylor. What I do is I break down the stock market or investing in general, and I take a look at it from the perspective of fundamentals, economics, what drives what and why. And right, so if that is what you're looking for, make sure to hit that like and follow button. I just launched this channel a little while ago. It's doing very well. The growth is quite rapid. Thanks so much for all those following along. And we are looking right here. This is the 1 month U.S. 10-year Treasury yield. Yield on the 10-year. This is the benchmark across the board. You have a choice. You can either invest in the 10-year yield or not. That's the way we kind of look at it from the investing perspective. This gives us the benchmark. And right now we're pushing about 4.5% to 5% in the 10-year. Of course, the 10-year did drop a little bit over the past couple of weeks because the outlook for interest rates are changing. So at 4.5%, that's your benchmark. Now you're going to ask the question, okay, what could I invest in? Will it outperform the 10-year? Or should I buy into the 10-year? Now, the 10-year Treasury yield, of course, being a benchmark, the risk to reward is actually skewed quite heavily towards reward at this point. Taking a look at this yield, over the past 20 years, a little more than 20 years, when yield is this high, your downside risk is quite low. At the same time, what's happened is because yield has been so low, we've been in an ultra low interest rate environment, stocks have pushed higher as they chased yield. Meaning, what did a company earn, earnings per share divided over top of total, the price that you would pay at any particular point? That yield kept getting smaller and smaller and smaller because the benchmark 10-year was as low as it was. Investors were willing to take on more risk with investing into a stock with a lower yield because the alternative was so low. That's how that kind of breaks down. This being the benchmark, the 10-year is where you really kind of start out with your investing. So we're looking at XLP and XLY stock. And in this case, this is XLP. A quick breakdown of the top. There's about 10 stocks here. These are the top holdings within XLP stock. Gives you an idea as to what these staples products. Personally, I don't consider PepsiCo being a staple or Coca-Cola, but these are things that during an economic upturn or downturn, steady as you go, steady as you go, steady as you go. XLY stock, of course, this is the discretionary. So, and as you can see, some pretty heavy weights in there. Amazon being almost 25% of the holdings of the index weight. This is what's really driven XLY stock when you look at this. Tesla, sure, we could use a car. Do we necessarily need a Tesla? That's why it becomes discretionary. Let me break something down for you. Economists, the core basics, you have your income, pre-tax. Anything after tax is considered 100% discretionary. But within the investing world, they kind of say there's staples expenditures and discretionary expenditures. And as you look down, some could easily argue that Starbucks is not discretionary. Well, your morning coffee may be a staple, but the premium version of it could be discretionary. That's how that kind of breaks down. Here is a look at the bar chart itself, SPY stock, which is the ETF versus the S&P 500. Then we have XLP stock in orange, P being staples. I'm trying to kind of give you a little way of looking at that. XLY discretionary is in, of course, the turquoise color. The S&P 500 over the past year has outperformed across the board. It's up about 10%. And this is a touch more than 1 year. I think I've got about 15 months, 14 months here showing. I think it goes back to August of 2022. Finally, XLP stock didn't really do too well over the course of this period of time. You can see the breakdowns on the side there. But this is over just the past year. Here's a bigger look. The S&P 500, of course, is still in the bar chart. XLP, the staple stocks, performed about 175%, 300% gain over the past 20 years out of the SPY stock. And then, of course, XLY, discretionary ETF, outperformed everything, almost 500% during that period of time. So over the past year, the S&P 500 SPY stock has outperformed everything. But that's just for this year. Over the long haul, there's been significant growth in these stocks, and you can see that breakdown like that. Here are consumer staples versus consumer discretionary. These are dividends. All right, not earnings per share, but dividends. And if you owned XLY and XLP, yeah, you get dividends. XLY, if you kind of break out and take a look at this, seems to be kind of stalling out. Now, XLY, of course, was discretionary. Amazon, Tesla, Starbucks. Starbucks is a great investment. They should continue to see increasing revenues. Tesla, maybe not so much. Amazon, a little overvalued, but that's a stock that will probably continue to increase once it revalues itself. XLP stock is kind of continually moving higher and higher and higher. Now, seems to be the flip of what we saw in those charts. You're seeing continued growth in earnings for the staples, but not so much. The green bars there are really kind of flatlining a little bit. They haven't really grown too much since 2019. If you go back to 2016, still haven't cleared that annual growth for, now again, these are dividend yields, but dividend yields are a percentage of total earnings. So it kind of gives you an idea of what might be going on. But here's the real big picture that I kind of break down. We go back to the 10-year Treasury yield, which is at 4.5%, will likely push again to 5%. We don't know. We're getting more and more information. My outlook, 2024 stock market analysis outlook, is real simple. I think we're probably going to see stocks kind of trend a little bit higher, but the reality is the Federal Reserve did not get it right. They either overshot or they undershot and need to move interest rates. either drop them or raise them. Most people believe that in 2024 we'll see interest rates moving lower. I'm not in that camp. I think we don't have enough information right now. I also think the Federal Reserve did not get it right. They will have to do something. In the scenario where the Federal Reserve has to raise interest rates more, this is kind of where I'm leaning towards. We're seeing some contraction in the economy. We're seeing revenues kind of decline. We're seeing profits decline. We're seeing unemployment creep upward. What I think is probably going to happen is we'll see unemployment creep upward to some extent, and then this economy will probably keep going further. Because of that, the Federal Reserve is likely to have to step in and raise interest rates further towards the end of 2024. In the meantime, probably see the stock market moving up a little bit all through, say, May, probably go sideways all through summertime, and then probably another sell-off in September, October, November, December kind of time frame. I believe the Federal Reserve did not get it right. I believe this economy will slow somewhat, but then turn right back upward. The M2 money supply, still way too big. They need to contract that, which is more important than the inflation rate. Inflation rate itself, if you take a look backwards, may take 2, 3, 4 years before we finally magically get below that 2% level that the Federal Reserve will be looking for. We're not there. That's not necessarily the bigger picture that they're looking at. They're probably looking at their balance sheet, M2 money supply, and the effects of the liquidity within the system. So when I break everything down like that, what I'm looking for is unemployment to creep upward, then turn right back downward. Stock market will expand somewhat, and then probably next fall, we'll see it sell off again because the Federal Reserve is going to be forced to push interest rates further. The other flip side is, what if the Federal Reserve went too far? They will be lowering interest rates rapidly because they tanked this economy. That's not an economy that you're sitting there rushing in and buying stocks. You're waiting for there to be a bloodbath, then you buy your stocks. We don't have enough information right now. What they did takes time to work through the system. I favor that the Federal Reserve is likely to have to raise interest rates further and keep them there for a long time. In that scenario, stocks look pretty nice, except for the fact that they're overvalued. You go back to the 10-year, 4.5%. Compare any holdings you have right now to future earnings over the course of the next year with those stocks versus the forward earnings. A lot of these companies are yielding 2.5%. Investors are going to be sort of hesitant to get into these prices when they can invest in the 10-year yield at 4.5% with little downside risk. If the Federal Reserve does raise interest rates somewhat, the 10-year might push to 5%. It's sitting at 4.5%. Maybe it hits 5.25. That's your downside. As yield goes higher, price goes lower. More and more investors will be buying in on that 10-year. You take a look at the yield you're getting on your stocks, you're hitting the sell button because you're only potentially getting 2.5%, and investors are not going to rush in to be buying it. Those stocks will start to wobble and come down lower. The 10-year yield is the benchmark. It's higher than most stocks. Because of that, a lot of individuals are going to be sitting there selling and opting for the 10-year. I don't see stocks really just sailing higher. I see them kind of moving sideways, lower, sideways, a little bit lower, maybe a little bit higher, maybe a little bit lower. But as long as the 10-year yield remains high, and if we start getting more and more information that unemployment is slowing down, the rate is starting to move lower and lower, If M2 money supply does not contract the way the Federal Reserve wants to, first and foremost, they keep interest rates where they are. This will send a little ripple effect to the stock market. But eventually, if we start seeing more and more information, CPI data not quite getting there, M2 money supply not quite contracting enough, then we start to see employment numbers improving. The Federal Reserve is probably going to have to start pounding their chests further and further and saying, we will keep interest rates up high for a long time. This will wobble the stock market. We start getting more and more information that things are getting robust. The Federal Reserve steps in, raises interest rates. Stocks sell off. So when we look at discretionary spending and staples, they're on the bit of the high side. Now, discretionary clearly outperformed the S&P 500. Staples clearly underperformed the S&P 500. The nice thing about staples is, while they have underperformed, their value is, say, much better positioned than discretionary. So if we see discretionary and staples and the S&P 500 SPY stock moving lower, staples likely have less to move lower. But for those who are looking for income coming in, those staple stocks are likely to perform fairly solidly because they're staple products. No matter what, consumers have to step up and buy their Coca-Colas. I'm not that category, but I get it. So when you're breaking these down, first and foremost, take a look at the 10-year Treasury yield. That's your benchmark. And ask the question, any individual stock, how does it compare today? Would investors buy or sell because of future yield? Given future earnings, price today, which is the better investment? Also, consider the future economy. I think interest rates are probably going to go a little bit higher. Nonetheless, I wanted to break down XLP stock, the consumer staples ETF versus XLY stock, the consumer discretionary spending versus the S&P 500, so everybody has a good idea as to what's going on for consumers. It's 70% of this economy. It is important. Make sure you hit that like and follow button. I continue to put out information breaking down the stock market, how it functions, stock market analysis across the board. We'll see you in the next video.